Okay, everyone, I recorded a stock market technical analysis video earlier today, but something happened with my memory and I ended up having to re-record it. So we'll give this one another shot and I'll get this out to you. So the market's now closed and we can get a good clean look at where the charts are sitting at. We'll start out here with triple Qs. Triple Qs, as far as I can tell, had a false breakdown whipsaw signal, and it's pretty much confirmed at this point. We had the sell signal right there. That was a clean sell signal. However, the following day they snapped it back up and recovered that broken support line. So this green line comes off the March 2020 lows. Got a reaction right here. We got several reactions right in here, and then we broke. But again, false breakdown. So at this point, they've snapped it back up and we're back within this bearish rising wedge pattern. So here's kind of the top of the pattern. We could adjust this, if I wanted to adjust it to give it maybe the benefit of the doubt. You could maybe go like that. You only have 2 data points, but again, since we're so close, it doesn't hurt to really give it the benefit of the doubt. And we're still within this wedge. This pattern signals that we're going to get the breakdown. We just didn't get it, right here. That was a false breakdown. So I'm looking for another sell signal. Why am I not getting long here? Because we had that false breakdown. Well, 2 reasons. One, we have a bearish rising wedge pattern that we're pretty much at the apex of that pattern. Even if I adjust this to like here, we're still at the apex of the pattern. There's really no pattern I can make that doesn't give me a bearish rising wedge. So we're really close to where we should see a resolution of this pattern. And this is a bearish pattern that often has a higher probability of resolving to the downside. Nothing's guaranteed. It can resolve to the upside. It's just these have a higher probability of resolving to the downside. And then the next reason why is we have a long time extended negative divergence on the daily chart, on the RSI and the PPO. It just continues to extend. Let me adjust this, but right there, it just continues to extend and we have momentum waning. All right. So that's why I'm not looking to get long, while I continue to look for sell signals. And that's how I'm seeing it right now. Looking at the SPY, we have the same pattern, bearish rising wedge pattern. You can see it kind of marked out here with green marking the support. That support comes off the March 2020 lows. Reaction here, several reactions, and we had the breakdown sell signal. This was an impulsive breakdown and sell signal, and that hasn't been recovered yet. They closed today right at a back test, kind of a right at a complete back test of that broken trend. So again, Qs hasn't broken down. And SPY is closed right at resistance. So I would expect SPY to, start to sell off here. But without Qs breaking down, there's no sell signal until you get the Qs to break down. So I'm watching the Qs as my signal for continued downward price action in the S&P 500. SPY, same thing. Big negative divergence, bearish rising wedge pattern. The pattern's been broken, and now we're back testing resistance. So in general, this is right in the area where we should reject. Doesn't mean it has to, but the probability says that it will. A couple things to also watch: the dollar. Let's go to the DXY. We're getting a breakout in the dollar. The dollar's continuing to catch a bid, and we're seeing strength in the dollar. That should start to put pressure on risk assets. That should start to put pressure on commodities. That should start to put pressure on gold. And we'll continue to watch that. Now, if the dollar just stops here and turns around or runs up to 92, then that's where it stops, then we might not see that correction. What I would look for, if the dollar runs up to 92 and actually starts to break higher, I think it's a very high probability that the market will get that correction at that point. Okay, so dollar above 92 should start some sort of correction. We could be there tomorrow. We don't know exactly where this is going, but as of right now, continues to move higher. See the dollar futures continuing to break out. So the dollar's catching a bid. What does that do? Well, let's look at gold. Gold got the memo that the dollar is rising, and gold sold off down $40 today. Gold closing just pretty much right at this longer term support, 1790. So this was previous support back here, and this support comes all the way back from the kind of the top of the last bull market in gold back in 2011 through 2013. 3 reactions there, nice defined resistance back here, and so far nice defined support since we've broken above that. So you can see when we broke right here, when we broke above that support, it was a huge ramp higher, and then we came back in for a back test. It held again as support, bounced, and now we're back there again. So what I'm looking for, honestly, is just a little bit more move down in gold. Slightly down here to 1750, 1700. Make it look like it's breaking that support, and put in a bullish divergence on the RSI and the PPO. To me, that looks like the area that is probably going to be the buying area for gold miners, all that. So I'll be looking to buy down there. Okay, the long bond TLT continues to sell off. So what's happening is we're seeing a steepening of the yield curve, which means the longer term bonds, longer duration bonds, the interest rates are rising, and then the shorter end of the curve, the 4-week T-bills, the 2 years notes, they're being pinned by the Fed down to basically nothing. So we're seeing a steepening of the yield curve, which in general benefits financials, and that is continuing to actually play out. So if we go down to XLF, you'll see the financials catching a bid today. While you continue to see a steepening of the yield curve, you should see financials continue to show strength. So for me, I did mention on the Citi trade, the Citibank trade, we did catch this short right here, a little bit of a short. And, from the high to the low, that was a drop of 17%. So not a bad short. Obviously, I didn't catch it from the very high, but, there was profit to be made. I mentioned the other day that I covered that short. And the reason why I covered it is the hourly chart had some bullish divergence, and it looked like we were going to run up to this resistance line. As of right now, with the yield curve continuing to steepen, I want to see a change in that structure before I re-enter into a banking short banking stock. So if we don't see a reversal or change in that structure of the steepening yield curve, then financials could continue to rally. So I'd be looking for TLT to rise, and if TLT starts to rise, that will start to put pressure on the financials. So that's potentially the next leg down. If you get a rise in TLT, look for financials to start to be weak and make the next leg down. Until you see that, though, I prefer to just kind of sit on the sidelines on this one and look for it. Quick look at the fangs here. So Apple, as of right now, had a false break higher. So this was a bear trap. However, we haven't broken the support line yet. Coming all the way back from July 2020, there's a support line. I'm looking for a breakdown of that. But before that, if that doesn't break, the Qs is not going to break down. So need to see that. Until then, they're still catching a bid. Microsoft. We have this resistance line right here. We made a quick overshoot of it the other day, and it failed. And then today they just came back in for a back test. So watch this line here at 242.60. A break back above that should be bullish, and especially if you get the close above it, a break, and then a rejection of that level, and we start to move lower, will look pretty bearish. If we come back down and break below this 227.76. then it's pretty bearish at that moment in time. So looking at those levels for Microsoft. Amazon, we have this downward trend line right here coming off the all-time high. And let's see, my trend line looks like it's just slightly off. Let's adjust it. There we go. And, recently broke above it after earnings. They sold Amazon down right after earnings. And we today just came back in for a back test of that trend line, still below resistance. So we'll see how that plays out and if that holds. A break above it and it can hold is bullish. A rejection here would be bearish. Look for look for tech to start to break if you start to see these large caps get rejected. Google, same deal. Ripped it higher after earnings, but then sold it back down and closed. So we've got kind of resistance at the gap, basically the gap level, which is right about 2060.350. A rejection here, bearish. Look for gap fill all the way down at 1936 or so. And a recovery and hold above is bullish. Another thing to point out, the ag commodities, yeah, they sold off a little bit. Nothing major, though, today. So as far as I can tell, the market thinks the dollar is not going to go beyond that 92. And the market thinks that, we're coming near the end of the run for the dollar rally. And they're expecting the dollar to continue to go lower from there. If that doesn't happen, that's when you get the big shakeup, when the market's caught off sides. Because right now the market is positioned for the dollar to not go beyond that 92 on the DXY. So something to watch for. That's there's a trade there to be made if you see the dollar start to rise above that 92. You'll start to see markets selling off. And a lot of these, anything dollar sensitive will sell off. Gold's obviously already started to sell off, but if gold holds in this area, then it's the same kind of thing. Dollar, the market's position for the dollar to not go much beyond this 92 level. So oil, looking at XLE, is one of those dollar sensitive commodities. And again, oil's still as of right now, it's kind of hanging in there. It's not selling off, not getting rejected at this resistance level 42. So again, I think oil traders and everybody in oil is looking at that dollar and looking at that 92 level as kind of the top. And if it is the top of the dollar and the dollar starts to sell off, then oil can and should likely continue higher if the dollar continues to sell off. So watching for that. That's going to be a big key level in the dollar, and there's a test coming up. So there will be a trade there. As of right now, we have to just see if we get rejected here at this 92 or if it continues higher. I don't see any bullish divergence in oil. What I see is momentum continuing lower. You can see there we have, we basically have negative divergence, and momentum is making a new low. And yet price made a higher low. So I continue to see negative divergence there. It really showed up right there. And this was a divergent high, signaling we were going to get a pullback. We did get the pullback. Is that enough to, satisfy that divergence? I don't know. But that pullback was a drop of about 13.5% from the high, from when we put in that divergent high. Maybe that's all there is, and maybe this does want to continue higher. So, it's about managing the trade and seeing what happens with the dollar on this one. Someone asked me about Snap, and they asked me what I thought about Snap earnings. And again, earnings are, are complete crapshoot, basically. You don't know how the market's going to react to the initial news of earnings, or when the market opens maybe the following day, how it'll react. But you can use the charts to give you a sense of where the direction will go after earnings. Sometimes the earnings will come out, the market will buy it up, and when the market opens up, then they sell it down. So again, the initial announcement is a crapshoot. This chart, though, on Snap, and I commented to that person, I said, if I had to pick one or the other, I'd pick down. And the reason why I would pick down is negative divergence right here on the daily, bearish rising wedge price pattern, and those are bearish setups. So I would pick down with a bearish momentum and a bearish rising wedge. I would have to pick down over up. You can see the after hours. They're smashing this thing down to almost 10%, 9.5 or so. So looks like it's going to open. Right now, it's right at support, right around this 52.76. So it looks like it's going to open down at this trend line. So again, what I'd be watching for at the open is, do you open, do you break this trendline support? Do you open right on trendline support and fail? These are things to watch for. And then that could give you a potential trade for a breakdown and run down and do a gap fill all the way down here at 29.20. I don't think we'll get there tomorrow. Obviously, that's a huge drop, but this could be the start of a trend down to gap fill. Peloton also looks like they missed on earnings, whatever that is. But the earnings, they're only down. It's down 6%. But they ran it up 7% today, so it's basically just giving back what it ran up today. To me, that looks like a false move higher. And if you look at the hourly, you can see we've really been struggling over the last few days in this zone. It's just been kind of basing out and going nowhere, just chopping around. Today they broke it to the upside, but after hours looks like they're breaking it back down. So this zone still is relevant. All right, so we're looking for a breakdown of this zone to continue lower. I think we're going to get it. We have negative divergence on Peloton. It remains on the daily chart on the RSI and the PPO. We've broken uptrend support, kind of the upward price momentum, and I do think we're going to start to trend down. We need to just see a breakdown candle, start to get that impulsive breakdown. I'd be looking at this level right about here, 145. We'll call it 140. We'll call it 144.80. You get the daily close below that 144.80, and I think that's good. That sets us up for a move all the way down to what looks like about this 118.60 area. We had this big ramp higher, and I think if we start to head in that direction, we're going to come down and kind of close that gap down there. It's not really a gap, but we're going to kind of close that ramp higher. So look for those, look for that price action. Another thing is I entered this Peloton short right here on the gap up. This is when we got the negative divergence. Right in here is where I entered, and that is when we put in negative divergence. We made a lower peak than the previous high. We didn't have negative divergence on the daily chart until then. So that was the entry. That looked like the objective, best entry. And you can see we have not, this is still a profitable trade. They, kind of started to break higher just briefly, but it continues to work. So we're going to let this one just continue to play out. Qualcomm, clear sell signal. We actually got the sell signal the other day. This was your sell signal right here when you got the impulsive breakdown. And what they did is over the next few days, they ramped it back up and did a back test of resistance, which is this downward trend line on the daily chart going all the way back to March 2020. So nice clean upward channel. Broke that channel support. This is the very first breakdown that we've ever had in that price channel. They did a back test, made it look like it recovered right here, and the following day they gapped it up and opened it way up here, but it instantly rejected and closed back below resistance. That was your tell right there, and I pointed it out in the video. I said, look, this is interesting. That candle gapping above support and being instantly rejected. If we go to the hourly, I think it was rejected. Yep, the first hour, you can see instantly rejected and then spent the rest of the day just going nowhere, sideways. And then obviously they had bad earnings and they smash it down today. So this thing's going lower most likely. Next level of support, I see we got some support right here at about 141.84. We're kind of right in the middle of that right now. So any kind of rallies I'd be looking to sell into. But I do think we head down here, hit some support. We'll probably dance around here for a little while. And then if we break that, which I do think we will, then we've got a gap filled down here at 129.55. We will likely get a reaction there. We start to break that, and we've got a gap all the way down here at 93.90. That's kind of my final price target for this trade idea, down at 93.90. And that's a pretty good drop. Let me get my tool here. That would be a drop from where we're at now, because we've just had a almost a 9% drop. That would be a drop of about 36%. All right, so that's kind of the trade idea on that one. It's it's continuing to work. Okay, this one, Digital Turbine. So I took a short on this the other day, right here when we were at support, and I was anticipating a gap down on Monday. We didn't get the gap down on Monday. I instantly closed that short. I mentioned that in the video for very small loss, and I bailed from that. Clearly, that was the right move to do because since I closed that short, this thing is pretty much up. Let's say from here, it's up 30% in just a matter of a couple days. And again, that's why when I didn't see the gap down on Monday, it wasn't, this thing is not going to just drift lower. It is going to be an impulsive break when it breaks. And when I didn't see that impulsive break, first thing, right at the open, closed the short and, moved on. So they reported some sort of good earnings. Now they're above the bearish rising wedge. This is a bearish rising wedge pattern. We're above it. So usually the way this plays out is, they ramp it a little bit up in this area just for a little bit, and then it breaks down. So what I'd be looking for is a breakdown, and ultimately this now when it breaks, it's likely going to break this lower support line here. So as we start to head back down to support, keep an eye out for that breakdown. Until we start to break down, though, I'm just going to let this thing kind of do its thing because they could ramp this thing kind of straight up and then fail. It's not, I'm not interested in it until we really start to get down and look like we're going to break this lower trend line, or just wait for it to break. That's another potential. I just think by the time this thing breaks, it's going to be a pretty impulsive gap down. You might not want to short at that point. So you might have to step in a little early, but again, if we're heading down to this trend line again, that might be the area where you could potentially step in early. Okay, we'll wrap with volatility. Here's UVXY. A lot of people pointed out, why do I chart this? Because this is a leveraged derivative of the VIX, basically, which tracks derivatives, essentially. I don't use UVXY over the long term to give me long-term buy and holds or any. This is not a buy and hold instrument. Okay, UVXY is a pick your spot kind of instrument. Wait for certain things in the market to line up and then wait for a break higher. And so what I do for these ones, UVXY and VXX, I use the SPY, and I look for signs that the SPY is going to start to sell off. And that's where I look for signs of building volatility positions and whatnot. So volatility continued to show me in the short term, this pattern right here, that we were going to get a spike because we started to see bullish divergence on the daily chart. And we were kind of holding this support over a month or so. And then we did get the spike. This was up about 50%, a 50% rise. What I was looking for initially was a pullback and then another move higher. We didn't get that. It just went the other way and completely collapsed. This is a collapse of volatility. So the market just sold this thing down. So as of right now, I don't see any other position in this until we get a breakdown in the markets. Now, if the markets start to break down, we'll see volatility spike again. But until then, that's all I see on this pattern. So I think it's likely this bullish divergence has played out. Now we just let this thing continue to drift lower, because that's the thing. And this could easily, we are at resistance on the SPY. Going back to here, we are at resistance. So if we're going to reject here, we should see volatility, continue to, or spike again. But we got to, I'm waiting for that rejection of the SPY. All right. And ideally, you see the rejection in the Qs too. If we don't get that volatility, this UVXY will continue to drift lower because of the decay. So these have decay in it, and that's why if you look at the longer term chart, they're down. All right. This is not something that you can just buy and hold. If the pattern doesn't work out and you don't see what you need in, you can hold these things for a month or so. It's not, the decay is not going to really get you too bad. And if you get your volatility spike, it will well make up for that decay. But this is not a buy and hold. Don't get sucked into this thing and thinking you're going to get, that you're going to, get it. If you don't think that there's a volatility spike coming, you know, then it's time to get out of these and wait for that next opportunity. Okay, that's all I got for today. Let's see what tomorrow brings and how we close the week. And, you know, potential for a big down day tomorrow. Doesn't mean it's going to play out, but SPY is at resistance. You know, and if we're going to get those weekly chart, you know, that weekly candle confirming that breakdown that we had on the SPY from the previous week, then we need to see a pretty big down day tomorrow. Doesn't mean it's going to happen. I think it's probably pretty low probability, but it could. So we'll just wait and see. And I'll catch you guys in the next video. Bye.